What makes the difference between a great whole life insurance policy and a bad whole life insurance policy? Specifically, when I am focused on cash value, why does one policy look fantastic? I see rich cash values right off the bat, and then one looks just horrific. I look at it and say, man, it takes me more than 10 years to get my money back. Why on earth would I put my money here? And I don't get why big banks and corporations put their money here. Big banks and corporations put a lot of money in cash value life insurance, but it is cash rich from the get-go. So why would we as an individual consumer want to do anything or want to do things any differently? So we typically have those two opposite ends of the spectrum. On one side, you've got individuals like Dave Ramsey, Susie Orman, financial advisors that are anti-whole life, saying whole life insurance is the worst area you can ever put your money. Horrible returns. You're way better off buying term and investing the rest. And then on the other side, Bank of America, Wells Fargo, and most banks in the United States have cash value life insurance positioned as an asset on their balance sheet, as one of the top tier 1 assets on their balance sheet. They put as much as they possibly can there. Same thing with corporations, wealthy individuals. Going back to the first video, those core benefits being a safe, liquid, tax-free area to position money, specifically focusing on wealthy individuals. That's why they do it. So why is it different? Why does a wealthy individual get the good stuff, and then I, even if I'm paying in $100,000 or $1 million per year, does it look so much different? Well, it is all in the design, what we ended with in our last video. When I design a whole life insurance policy, or put it another way, when you pay any amount of money into a policy, you, the policy holder, the policy owner, can actually choose where your money goes. It can go toward one of two areas at the end of the day. You can direct your money toward the premium, which we'll often refer to as the initial insurance expense, or you can pay your money toward the PUA, stands for Paid Up Additions Rider. English translation, cash dumping. We're dumping money straight into cash value. So regardless of what we call these two areas, what I want to know is, all right, if I'm going to pay money toward either of these areas, how does it actually impact my policy? So again, I'm coming to you, pretending that I'm the consumer, I'm coming to you and I want maximum cash value. I've heard all these great things about cash value life insurance, but then I see examples that have nothing to maybe 50 or 60% of my payment up front, and I want to see it there. So if I'm going to pay money toward these two areas, dollars that are directed toward the insurance premium, let's pretend I'm going to pay $1,000 per year toward the premium and $1,000 per year toward this PUA component. The premium component, in respect to your cash value, what you will find in the first year, and sometimes the first and second year, depending on the company and product, next to nothing or a very, very small percentage of my payment shows up in cash value. The reason why is that the company is going to overcharge me for the death benefit, the actual amount of life insurance up front. Now, as we continue to make payments, when you hit the third year, you'll start to see that $1,000 premium payment come back to cash value. Begins to compound, yield dividends and interest, gets better and better as time passes. But the first year, and sometimes the first and second year, nothing in cash value. Versus this PUA component, we call it a cash dumping, because when I pay that same $1,000 here, guess how much shows up in cash value? Just about $1,000. I say just about, it might be $980 right off the bat. Depends if the company has a PUA rider fee, which most do, and we've got other content on that. But you will see the majority of that show up in cash value. That's money you can access and begins to yield the guaranteed rate and dividends right off the bat. Now the term paid up additions represents the fact that when I pay money into this component of a policy, it purchases me paid up additional life insurance. Why it has the phrase paid up in there is because PUA dollars are optional. I can make those payments, I can decide not to. It's very flexible in that respect. Let's continue on. So a question we often get here is, okay, I get that. I don't care about the death benefit. I'm interested in max cash value. So how do I set the policy up where I pay nothing toward the premium, 0% of my payment here, and everything else into the PUA component? Can I do that? And the answer is I wish, but no, unfortunately we cannot do that. The reason why is that there are limits on life insurance policies. 2 limits specifically that I have to deal with. I have the insurance company limitations, and then I also have the IRS limitations. Let's go through each of them, and then we're going to look at some examples here too. So when it comes to limits, first I've got the insurance company limitations. And if I were to focus on the top companies, take the 4 major mutuals for example, I can typically drive that premium as low as 10% and then direct the other 90% toward PUAs. So what this means, to be specific, is if I have a $1,000 minimum premium, that means I can direct another $9,000 into PUAs per year for a total of $10,000 per year. Can also design this to be very flexible, where I may only commit to approximately $1,000 per year, and then at my discretion I can add up to another $9,000, but again, it is in my control as the policyholder. I am not billed for that. Different companies have different flexibility features. We'll get into that more in later videos. So my money can go toward these 2 areas. This will accelerate the cash value short-term and long-term when you look at actual policy performance, policies that have lived the test of time. So the first limit I have to deal with is the insurance company limit, and that's if I'm paying in $10,000. If you add a 0, make that $100,000, you would literally just kick that premium up to $10,000. The other limit is this guy, the IRS limit, MEC, which stands for Modified Endowment Contract. So if we were to go back to the core benefits of a life insurance policy, what do we have? Safe, liquid, tax-free area to position money. Any life insurance policy can become classified as a modified endowment contract. If a MEC occurs, I have to deal with taxes on the cash value. To be specific, if my policy becomes classified as a MEC, the cash value still grows tax deferred. However, anything I access whenever I want to withdraw or loan money from my policy, I have to deal with ordinary income tax on the gains and an additional 10% penalty if I touch that cash value prior to age 59 and a half. In short, it completely ruins the plan, gets rid of all of the cash value benefits, not all of them, but most of them, restricts access. A lot of people don't like it because they utilize cash value life insurance as a tax-free area to position money. So how we prevent it is as follows. Every policy has what is called a MEC limit. Another name for this is a 7-pay limit or 7-pay test. Now the beautiful part about this is we can set that MEC limit wherever we want. What you'll find is that it has a direct relationship to an individual's age and total death benefit on a life insurance policy. Let's demonstrate this a bit. So what we're going to look at next is an example of a 40-year-old male who wants to pay in $20,000 per year. So we have an age 40 male, $20,000 per year through age 65. Okay, so I want the ability to pay in up to $20,000, but again, I do not want to get billed for that. So from a design standpoint, what would I want to do? Set that premium at $2,000, and then I can add another $18,000 per year into PUAs, in theory. So we're going to look at some different examples here. This will be fun. So what we will begin with is a policy with a 100% base premium or insurance expense. Then we'll look at a 50-50 split. What that means is 50% of the payment will go toward the insurance premium. That would be $10,000 of the $20,000, and the other 50% toward PUAs. And then one last option with a 1090 split, a 10% minimum premium, $2,000 in this example, and the other $18,000 directed toward PUAs. And this would be exactly the same if we looked at $200,000, $2 million, whatever the dollar figure is. As long as the ratios are set up properly, you will see consistency in performance and flexibility. Let's get into it. So what we're going to look at first, traditional old school whole life insurance. If you've ever been presented a whole life insurance policy and you're just looking at, hey, I was told to put this much money in, I get a death benefit, but then I questioned it and said, this doesn't build any value, I'm not doing it. It probably looked like this. So here we have a policy, 40-year-old male, paying in $20,000 per year. So again, if this is me, my question is going to be, if I've got $20,000 going in, where is my money going? Because again, where can it go? Toward the premium or the PUA component. This example is a 100% premium policy. Base premium, $20,000. $20,000 goes in. Total cash value column right here, about $3,000 right off the bat. If I were to look at the guaranteed cash value in this example, I would see 0 in the first and second year. Why I see a little bit of money show up in this example is there is a dividend paid that does kick a little bit of money into cash value in the first and second year, but not attractive at all. As I look at this as time passes, by year 5, I've paid in $100,000, I've got under $60,000. By year 10, at age 50, I've paid in $200,000, I've got about $174,000, taking a long time to capitalize this. Breaking even, really between years 13 and 14. Year 13, I've paid in $260,000. I'm at $258,000, about $259,000. And year 14, I'm finally positive. That's a long time to get your money back. Now, some things I want to touch on here. So we touched on where our money's going in this example. Now, that MEC limit is really what I want to focus on. So our premium of $20,000 gave us next to nothing in cash value. So what did it do for me? Assuming I'm interested in cash value. That $20,000 purchased an age 40 male, a death benefit of $1.35 million. Now, we'll assume this individual said, hey, I don't care about the death benefit. I'm interested in the cash value long term. Maybe he's single with no kids. Or maybe they're already protected with term insurance. 1.35, here's what I'm interested in here. Bottom right-hand corner of the illustration, look at that. So that death benefit, remember where we talked about? The MEC limit has a direct relationship to what? An individual's age and total death benefit. Here you go. For a 40-year-old male, $1.35 million obtains me a MEC limit of $48,500. So what this means is I have the ability to pay up to $48,000 per year, meaning I'm paying in $20,000. If I wanted to, I could pay in another $18,500 per year, which would all go toward the paid up additions, that PUA rider, to further accelerate the cash value growth. So one advantage to this design is I do have some window room to add more money to the policy if I wanted to. But if $20,000 is my number, not that attractive. And again, this would look the same if I'm looking at $200,000 per year. Now let's look at the age 65 cash value. So he's paying in $20,000 per year. He would have paid in a total of what? $500,000. Cash value $786. That's what it has accrued to over time. Okay, so $786, where he's paid in $500. Next, let's take a look at that 50-50 design. So 50% premium, 50% PUA. So first thing is first, where is my money going in a life insurance policy? Because where can it go? The premium or the PUA component. This is what you want to look for in a life insurance policy. Here's my premium, $10,000 in this example, and then here's my PUA component, the other $10,000. Net out of pocket is the same $20K. So for the consumer, he's still paying $20,000 per year through age 65 for 25 years. What's the difference in cash value though? Look at that. Right off the bat, about $11,200 instead of $3,000. Significantly better right off the bat. So greater cash value. You'll see this from start to finish. Let's look at that real quick. When did the last example break even? About year 13, year 14. Here, you're breaking even between years 9 and 10. By year 9, I've paid in 180, I've got 178. By year 10, I've paid in 200 and I've got north of 200. By year 25 in the last example, I had 780,000 and change. Here I've got about 826. So this is the same company, same 40-year-old male, same health rating. Everything's identical here, especially to the consumer. He's still paying in $20,000. Like it's all the same to him. He's just now been exposed to a different way to direct that money in order to maximize the cash value. So the advantage of this design compared to the last design, this has more money from start to finish. What's the trade-off? MEC limit. What did that 100% premium policy have in a MEC limit with that $1.35 million death benefit? It's about $48,000. In this example, we lowered the premium. So here's my $10,000 base premium. The last example, it was $20,000, which purchased me a death benefit of $1.35. Here, it's $10,000. What's your initial death benefit? $711,000. Less than the $20,000 example, almost 50%. Not quite, a little bit more, because the PUA component does purchase us some death benefit, but drastically cut in half, or chopped down, I should say. Now $711,000, let's see how that impacts the MEC limit. Again, assuming this individual says the death benefit, yeah, all well and good, but I'm interested in the cash value here. So again, MEC limit has a direct relationship to what? My age and death benefit. DB of about 700K, 25,000 and change. When he had a death benefit of 1.35 million, his MEC limit was what? About 48,000 and change, 48.5. So as we dropped the death benefit, the MEC limit came down as well. But our trade-off was cash value. So now let's look at a 1090 split. So what we want to look at here, going back to limits, my money can go where? Insurance premium or PUA, and how low can I go on the premium? Typically that 10% floor with this company, that's how low I can go. Of the 20,000, here's my $2,000 premium. The rest is directed toward PUAs. Now there is an issue with this policy, but first I just want to show you the impact of driving that premium low if you are interested in maximum cash value. Just about $18,000 right off the bat. Okay, breaking even between years 4 and 5. Much, much stronger. Now it's starting to look attractive, especially when I look at it up front and long term. Here's what I want to hit on. Look at your death benefit. It's $200,000. In that 50-50 design, we had a death benefit of what? $711,000, which gave us a MEC limit of about $25,000. Now, $204,000 gives us what in terms of a MEC limit? $7,300. This policy is a MEC. Does not work. The reason why is as we drop that premium down to $2,000, that dropped the death benefit, and wanting to pay in the $20,000, too much. We're violating the MEC limit. So we hear that and say, okay, doesn't work. How do I raise the MEC limit? That's the question. How do I raise that MEC limit so I can pay in $20,000 per year? There are two ways I can raise the MEC limit on a policy. Well, one way, by raising the death benefit, but there's two ways to raise the death benefit, because what has a direct relationship to my MEC limit? Age and death benefit. How do I raise this is the question. Two ways you can do it. One, you can increase that premium. But then we start to go backwards. We retract and go back to that 50-50 design or 100% base premium. We have to go higher, so I don't want to do that. How do I keep it at $2,000 and raise the death benefit? And how we do it is by adding term insurance to the policy, a term insurance rider. This is a cost-effective, or you could use the word cheap, method to raise the death benefit. And when we raise the death benefit, what happens? We raise the MEC limit. So this is often the most effective method to raise the death benefit, raise the MEC limit, keep your costs low, and plow money into cash value. Let's take a look at a non-MEC policy. So here we go. 1090 design, same $2,000 base premium. Difference here, we've got another rider attached to the policy, but here's what I want to touch on. Far right, what do you notice? Death benefit is almost $580,000. The column immediately to the left of the death benefit, amount of 1-year term, $370,000 and change. So we have term insurance attached to the policy, cost-effective method to raise that death benefit. We've got plenty of content on the different types of term riders. If you're interested in a level term rider or a 1-year term rider, I do like this type as it provides more flexibility. But let's get back on track here. So cash value right off the bat. Consumer, same thing. This is where it gets so interesting. So if you're considering a policy like this, or whatever dollar figure it is, you're 40 years old, let's pretend that this is you. You've now seen the same policy with the same company, same out-of-pocket to you, and all these different ways to design it. So this is where, from a basic standpoint, it is important to understand, okay, where's my money going this way? When I see a proposal, what should I look for to know that it's set up properly and I don't get buyer's remorse down the road? Minimum premium, if you can't find the premium, you'll see something like this. Cash value right off the bat, the majority of what I pay in, somewhere between that 80 to 90%. You can get it higher than 90% with some high early cash value products, but cash rich right off the bat. Breaking even here, still year 5. I've paid in 100, I have 100. And this is with a traditional policy geared for strong long-term performance, not high early cash values. That is an early break-even point for a policy geared for strong long-term cash value accumulation. Let's look at this guy. Death benefit about 580. So again, we'll pretend that this individual says, I don't really care about the death benefit. I'm interested in the cash value. MEC limit, about $21,000. So we're paying in $20,000. We solved for the minimum death benefit because, again, the death benefit has a direct relationship to the MEC limit in order to be able to pay in $20,000 per year, keeping my costs low, funding up to the MEC limit, building a little space. I don't know that I want it exactly at 20K. If we're funding for a long time, I want to overinflate that a bit. So a lot of data here, right? Let's simplify this a little bit. Let's take a look at the 3 examples side by side. So what we've got on the left, the 100% base premium policy, MEC limit 48.5. In the middle, the 50-50 design, 50% premium, 50% PUA, MEC limit 25.5. And on the far right, my personal favorite, the 1090 design, 10% premium, 90% PUA rider. You do have a term insurance rider in there as well. Now, in bold, you'll notice what? The base premium on each of these examples. The 100% premium example, $20,000 going toward the base premium, no PUAs. What's highlighted in yellow represents his break-even point. Traditional, old school whole life insurance. That's what that is right there. Designed for a high death benefit, but I just pay that premium forever and eventually see that cash value build up. Middle example, 50-50 blend. Breaking even between years 9 and 10, and then far right, breaking even clean on year 5. $2,000 base premium, $10,000 base premium, $20,000 base premium. Here's the other thing I want to touch on. Same company, same product, same payout rate. What do you notice in the red column on all three of these? The greater the cash value to the consumer, to the policyholder, the lesser the agent commission or compensation is. The reason why is we just went through, when I design a policy, my money can go toward the base premium or the PUA component. The base premium is the number one driver of the commission. There is a commission paid on PUAs as well. In this example, it's 2%, but we've got other videos that really go into full detail. What I want to touch on here is as we look at the cash value comparison and even the death benefit comparison long term, but then the commission comparison, this is where full disclosure or transparency is very, very valuable to me as a consumer and an agent. If I know this up front, I know, okay, if my clients are interested in maximum cash value, which just about all of our clients are, we want to show them how to do that, and it entails often minimizing the compensation. Now, on that same point, from a business perspective, if you do this and you've got happy consumers, what's going to happen? It's just going to keep on compounding over time. Volume play. So, over a course of 25 years, total compensation on the traditional policy to the agent, $33,600. The 50/50 design, $21,800, and the 1090, $12,360. That's the total compensation with everything, all the nuts and bolts included. Now, if I look at the age 65 cash value, what do I notice? We pulled these directly from the illustrations we just saw. Got more from start to finish. If I look at, let's look at age 85. Do we notice anything different here? More money up front, more money long term. Now these are based off of projections, but all things are equal with the illustrations, company, product. We do have in-depth case studies on historical performance, which shines a light and provides much more transparency on what actually happens, not just illustrations, but this hopefully was very helpful as far as understanding how a policy should be designed. If you have any questions, feel free to reach out anytime. Part 3 coming up next. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.